2022 has been a year of sell-offs. Many asset classes, global equities, global fixed income, are down by double-digit percentages. Now, that's interesting because debt and equities don't tend to move in the same direction during times of crisis. Here to explain this dynamic is Morningstar investment analyst Jeana Doubell. Jeana, how did we get here?
Well, Europe is dealing with a number of challenges at the moment. We're seeing dramatic inflation that's been exacerbated by the energy crisis with Russia, and there are also several economic weaknesses that are showing up in indicators, such as the Purchasing Managers Index. These factors together are spooking investors, driving bond prices lower and yields up. During such times of uncertainty, usually we'd see investors moving into safer, higher quality bonds, such as government bonds or investment-grade corporate debt. But 2022 has been unusual in the sense that investment-grade bonds and government bonds aren't acting as the safer spaces that they normally would. Investors are unable to basically shelter from the storm. In a sense, we've actually seen that the Bloomberg Euro Corporate and Bloomberg Euro Government Bond indexes are down 12 and 13% year to date. This is slightly worse than the high yield index, the Bloomberg Euro High Yield Index, which is only down 11% year to date.
And why hasn't higher quality debt outperformed lower quality debt?
Arguably, I'd say the biggest reasons are inflation and rising rates, with the former, rising rates, dominating bond markets at the moment. We're dealing with a duration sell-off as opposed to a credit crisis right now, even though central banks are hiking rates around the world to combat inflation. The reason why we're seeing high-yield corporate debt sell off less dramatically than more investment-grade worthy debt is essentially because this isn't a collapse in credit worthiness like we saw in 2008. The expected default rate for most indebted companies hasn't increased much. Actually, if anything, most issuers are well capitalized after having spent the last 2 years refinancing their debt instead of going out to market to create new issuances. So, while we have seen corporate yield bonds sell off, they've been less dramatic than other parts of the market that are perhaps more sensitive to central bank interest rates.
That sounds like a situation that many fund managers haven't come across in their careers. Would you tell us any European managers that you'd say are well placed to navigate this environment and actually make money?
Sure. We're seeing a range of different strategies play out in the market. Some managers, such as Nicholas Julian with Candrin's Bonds Euro High Yield Fund, which carries a Morningstar analyst rating of gold, is focusing more on rotating into companies that has a more defensive business model, such as telecommunications. This sector has actually demonstrated a robust stability over the last 3 years. Other managers are looking more towards out of benchmark positions to increase their alpha as they move the rest of their portfolio into higher quality bonds and lose out on high yields. So, for example, Jose Aguilar from BlackRock's Euro High Yield Fund has modestly increased their stake in Japan and Brazil for year to date. This is very interesting because, for example, Japan is one of the few countries in the world that hasn't increased interest rates. If anything, actually, it's dropped them.
An unfamiliar but also intriguing time for fixed income, especially high yield. Thanks for explaining all this, Jeana. For Morningstar, I'm Lucas Strobel.